Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamilton. Today, we're diving into a significant development that could impact mortgage rates in Canada. Experts are predicting that Canadian mortgage rates are likely to rise following a surge in bond yields this week. This prediction is based on a recent report from Mortgage Rates and Mortgage Broker News in Canada, which highlights a sharp increase in Canadian bond yields over the past 2 months. In this period, bond yields have jumped by over 61 basis points, with 17 basis points added just in the past week. This kind of increase in bond yields often signals a rise in fixed mortgage rates, as bond yields typically lead these rates. So, if you're shopping for a mortgage, brace yourself for potential rate hikes in the coming weeks. Ron Butler, a well-known rate expert, shared his insights with Canadian mortgage trends. He indicated that this rise in fixed rates is likely due to what he calls the Trump effect. This refers to the impact of former U.S. President Donald Trump's policies, which have continued to influence market trends. According to Butler, U.S. 10-year treasuries are tracking higher, and this movement often affects Canadian yields as well. Bruno Valco, Vice President of National Sales for RMG, expands on this by noting that Trump's pro-growth policies and tax cut promises have fueled market surges. These policies are seen as inflationary, contributing to upward pressure on wage growth and influencing rate forecasts by the U.S. Federal Reserve. Valco points out that the futures market currently prices in a 38% chance of a Fed pause in December, based on recent comments from Chair Jerome Powell about the strength of the U.S. economy. Turning our focus back to Canada, the country is grappling with its own inflation issues. In October, the annual headline inflation rate rose to 2.0%, up from 1.6% in September. This increase was anticipated to some extent, but the persistent nature of core inflation measures is concerning. Rate expert Ryan Sims remarked that inflation has not subsided as central bankers had hoped, and this trend is not unique to Canada, but is also seen in the United States and the United Kingdom. Adding to the inflationary pressures, the Canadian government announced a plan to distribute $250 to nearly 19 million Canadians, alongside a goods and services tax and harmonized sales tax holiday on certain goods from December to February. Some experts, like Ron Butler, view this as deficit spending, which could further drive inflation and perplex bond traders about Canada's economic direction. Despite the expected rise in fixed rates, there's an interesting shift happening with variable rates. Butler notes that while fixed rates may trend higher, variable rates are expected to become more popular as the Bank of Canada is anticipated to continue cutting rates. Ben Rabideau from Edge Realty Analytics mentioned in a recent call that variable rate mortgages are seeing a resurgence in popularity. While 3- and 4-year fixed terms remain popular, more borrowers are considering variable rates, especially those with a higher risk tolerance. As we continue to monitor these developments, it's essential to stay informed about how these changes might affect your mortgage decisions. We'll keep you updated on any further shifts in the market. Today marks a significant change for uninsured mortgage holders in Canada, as the stress test requirement for switching lenders has been lifted. This development, announced by the Office of the Superintendent of Financial Institutions, means that federally regulated financial institutions will no longer need to apply the minimum qualifying rate when a borrower seeks a straight switch for their uninsured mortgage. A straight switch involves transferring an existing mortgage from one lender to another without altering the loan amount or the amortization period. This change aims to provide financial institutions with the ability to take on what the OSFI describes as reasonable risks while still maintaining their prudential mandate. Despite this easing of requirements, the OSFI emphasizes that institutions should continue to adhere to the same standards as they would for new loans. This includes assessing the borrower's ability to handle debt and adapt to economic changes, such as reduced income or increased interest rates. This announcement coincides with the introduction of new loan-to-income limits on uninsured mortgage portfolios. According to the OSFI, these measures are designed to reduce mortgage lending risks and manage overall residential mortgage credit risk for institutions. In addition to this change, there have been other significant mortgage reforms in Canada this year. For instance, in September, the Department of Finance announced that eligibility for 30-year mortgage amortizations would be expanded to include all first-time homebuyers and Canadians purchasing new builds. Starting December 15th, first-time homebuyers and those buying new builds will be able to apply for a 30-year mortgage loan. Moreover, Ottawa plans to raise the price cap for insured mortgages to $1.5 million, which should help more Canadians qualify with a down payment below 20%. It's worth noting that this cap hasn't been adjusted since 2012. These new measures are part of the Enhanced Canadian Mortgage Charter, which also permits all insured mortgage holders to switch lenders at renewal without undergoing another stress test. This suite of changes is being touted as some of the most significant mortgage reforms in decades, aimed at helping Canadians buy and afford homes more easily. Canada's distressed condo market is forcing lenders to take on an unexpected role as developers. Instead of cutting their losses, some lenders are stepping in to buy unfinished projects and see them through to completion, hoping to recover their investments. This approach, known as a credit bid, marks a shift in the real estate financing landscape as lenders find creative ways to navigate challenges posed by rising interest rates and declining home values. This trend is particularly visible in Ontario, where projects like a partially completed condo development in Kitchener have been rescued by lenders. For example, Gentai Capital, along with partners ELM Developments and Doar Capital, purchased the project out of receivership for $75 million last month. Gentai converted its second mortgage into a majority equity stake, injected new capital, and secured fresh financing from Kingset Capital, allowing senior lenders to walk away without losses. While ELM Developments will manage construction, Gentai now finds itself owning the project, marking a significant pivot for a firm that primarily provides loans. Mike Chestachowski, vice chairman at CBRE Canada, explained to BNN Bloomberg that while the preference for lenders would typically be to get their cash back and move on, current market conditions have forced them to get creative. This isn't an isolated case, as CBRE data indicates that since interest rates began climbing in 2022, lenders have used similar credit bids to take over projects in Ontario, including a condo development in Wine Country, a suburban townhouse complex, and an apartment building near Toronto. The abrupt rise in interest rates has created tough conditions for developers, with many struggling to make mortgage payments. In fact, 2023 saw the highest number of receiverships in at least a decade, and this year is on track to surpass that record. For lenders, the alternative to stepping in often means selling projects at a loss. Chestachowski noted that lenders have to be optimistic about the market's future, believing a rebound is on the horizon, which makes this gamble worthwhile. Brian Doar, head of commercial mortgage lender Doar Capital and a partner on Gentai's Kitchener credit bid, expressed confidence in the market's recovery. He stated, "It will come back. If you can do this, I think it's the best solution for keeping the lenders whole." While a temporary oversupply of condos has cooled markets like Toronto, industry experts warn of an impending housing shortage. Sean Hildebrand, president of consultancy Urbanation, highlighted that a slowdown in new condo starts will significantly impact the market in the coming years. "It's really going to be a big dramatic change in the market," Hildebrand said. "You're currently dealing with a glut in the market at the moment, but it's a temporary phenomenon, and it's going to quickly turn into a situation of undersupply. As condo projects take years to complete, today's slowdown could result in fewer homes on the market later, potentially driving prices back up." While credit bidding is typically a last resort, more lenders are using this strategy not just to recover their funds, but also to stabilize prices and ward off opportunistic lowball offers. Mitch Vaninsky, a managing partner with KSV Advisory, who specializes in receiverships, noted that credit bidding allows parties to establish a floor and effectively deters bottom feeders. If a developer falters and bids are not forthcoming or below market, a lender has to be prepared to step in to protect its interests, he said. October witnessed an encouraging uptick in home resales across Canada, marking the most significant monthly gain since the close of last year. The numbers reveal a 7.7% jump in resales, heavily influenced by a series of interest rate cuts totaling 125 basis points from the Bank of Canada since June. However, this increase might not be as sustainable as it seems, according to a new analysis by the Royal Bank of Canada, which suggests the elevated pace of sales will be hard to sustain for now. George Hugh, the president and chief executive officer of Taurus Mortgage Capital, has advised brokers to temper expectations for a booming market in 2025. He points out that the Bank of Canada is closely monitoring the housing market to ensure that its rate-cutting measures do not overly stimulate home buying activity. Hugh emphasizes that while interest rates are a critical tool for controlling house price increases, the government is cautious about making drastic changes too quickly. Hugh predicts a measured approach to interest rate adjustments, suggesting they might eventually level out around 2.5% rather than dropping precipitously. He notes, interest rates went up 4.75 percentage points rapidly. Historically, they might drop by the same amount, but this time it'll be much slower, with careful monitoring of each adjustment's impact on the housing market. Interestingly, a cooler housing market can be beneficial for buyers, providing a stable environment over the next 18 to 24 months. Hugh believes that this period offers opportunities for both brokers and borrowers, even if the market does not experience the explosive growth seen during the height of the COVID-19 pandemic. Educating people about the market's eventual recovery is crucial, he explains. While it may not boom, it will rebound, and there are opportunities for informed buyers. Drew Donaldson, a mortgage broker at Donaldson Capital, underscores the importance of regulatory changes alongside interest rates in shaping the housing market's future. He notes that while these changes might enhance affordability, interest rates will remain the key determinant of market dynamics in 2025. Hugh advises brokers to maintain a realistic perspective on the housing market, encouraging them to provide clients with sound advice rather than simply telling them what they want to hear. Be patient and work with knowledgeable realtors who understand property values, he suggests. Avoid overpaying in anticipation of skyrocketing prices or underselling out of desperation. Make informed decisions and resist the urge to chase bidding wars. Despite the current market's sluggishness, long-term prospects for homeowners remain robust. The Canada Mortgage and Housing Corporation anticipates home prices reaching new peaks by 2026, even with the market's current lethargy. Sales activity is expected to slightly exceed the 10-year average, though not approaching the record highs of 2020 and 2021. For now, housing affordability continues to challenge many buyers despite recent interest rate reductions. Although mortgage payments as a percentage of income have decreased for the third consecutive quarter, home prices and savings requirements are still significantly above historical norms. A recent analysis from the National Bank of Canada highlights that while there has been a slight improvement, the changes may be temporary, with mortgage payments still high at 56.6% of income for the median-priced home. Today, Ottawa has unveiled significant updates to its housing plan, aimed at accelerating home construction and alleviating affordability concerns for borrowers. Among the recent developments are changes to mortgage renewal rules, tax incentives to spur housing construction, and measures to curb speculative home purchases by large investors. These initiatives are part of a broader strategy to address Canada's housing challenges and ensure that more Canadians have access to affordable homes. One of the key changes, effective immediately, is the relaxation of rules for uninsured mortgage holders at renewal. Borrowers with uninsured mortgages will no longer need to pass the mortgage stress test when switching lenders, provided their loan amount and amortization period remain unchanged. This reform, introduced by the Office of the Superintendent of Financial Institutions, is designed to give borrowers more flexibility in shopping for better rates without the added burden of requalification. This move aligns with existing rules for insured mortgage holders, who already benefit from stress test exemptions at renewal. In a bid to tackle rising rental costs for students, the government has initiated consultations to remove the goods and services tax on the construction of new student residences. Public colleges and universities are invited to provide feedback on this proposal, with a deadline set for January 20, 2025. Deputy Prime Minister Chrystia Freeland emphasized that building more student housing will help alleviate rental demand and address the financialization of housing, ensuring that homes serve Canadians rather than becoming speculative assets for investors. This initiative follows the September 2023 removal of the goods and services tax on purpose-built rental housing, aiming to ease housing pressures in cities with high student populations. Another significant measure focuses on reducing the financialization of housing by limiting large corporate investors from acquiring single-family homes. The government is consulting with provinces and municipalities to develop strategies to restrict such purchases. Public input will be accepted until December 19th. The aim is to ensure that prospective homeowners are competing with individuals rather than large investment firms, which have been accused of driving up home prices and reducing supply for families. Additionally, 12 more underused federal properties have been designated for housing development in cities like Calgary, Ottawa, Laval, and Whitehorse. This brings the total number of properties identified through the Canada Public Land Bank to 83. The program, launched in August 2024, seeks to convert unused federal land into housing with a target of creating 250,000 new homes. These properties are now available to home builders, with the government's emphasis on accelerating affordable housing projects nationwide. In support of provincial housing efforts, Quebec's Housing Accelerator Fund has received an additional $92 million in federal funding to meet high demand from municipalities. This supplements the $1.8 billion agreement signed in November 2023, which aims to expedite housing development across the province. Jean-Yves Duclos, the Minister of Public Services and Procurement, highlighted the importance of these initiatives, stating that safe, accessible, and affordable housing options remain out of reach for many Canadians. Since the launch of the Canada Public Land Bank, 83 properties have been earmarked for potential housing development, paving the way for affordable housing on an unprecedented scale. Today, we're focusing on a crucial topic for many Canadians: mortgage renewal. With approximately 2 million Canadians expected to renew their mortgages next year, there's a potential for significant sticker shock due to rising interest rates. Nico Wong from Blue Shore Financial has provided some valuable tips on how to prepare for these inevitable hikes and manage your mortgage renewal process effectively. Nico Wong suggests that one of the first steps you should take is to start preparing early. This involves reviewing your current mortgage terms and understanding how changes in interest rates might affect your future payments. By doing this, you can better anticipate the financial impact and plan accordingly. Wong also advises homeowners to shop around for the best rates. While it might be tempting to simply renew with your current lender, exploring other options could lead to significant savings. Different lenders offer varying rates and terms, and taking the time to compare these could result in a more favorable deal. Additionally, Wong emphasizes the importance of maintaining a good credit score. A healthy credit score can open doors to better mortgage rates and terms. If your credit score needs improvement, consider taking steps to boost it before your renewal date. This might include paying down existing debt and ensuring all bills are paid on time. It's also crucial to assess your overall financial situation. Wong suggests evaluating your budget and determining how much you can comfortably afford in monthly mortgage payments. If you find that your financial situation has changed, you might need to adjust your expectations or consider refinancing options. Finally, Wong highlights the benefits of consulting with a mortgage broker. A broker can provide expert advice and help you navigate the complex mortgage market, potentially finding deals that you might not discover on your own. Their insights can be invaluable, especially if you're facing uncertainty in the renewal process. As these tips suggest, preparing for a mortgage renewal is a multi-step process that requires careful planning and consideration. By taking proactive steps and staying informed, you can better manage your mortgage renewal and potentially mitigate the impact of rising interest rates. Today, we're highlighting a significant enforcement action initiated by the Financial Services Regulatory Authority, or FSRA, against Frankie, Attard. The FSRA has taken steps to address alleged misconduct involving Attard in relation to a mortgage transaction. According to FSRA, Attard is accused of providing false or deceptive information and documents, which is contrary to Sections 43 and 45 of the Mortgage Brokerages, Lenders, and Administrators Act of 2006. Additionally, it is alleged that he caused his brokerage to fail to comply with certain regulatory requirements under this Act, specifically breaching Section 3 of Ontario Regulation 187/08. The allegations against Attard suggest that he may not be suitable to hold a license under the Act. The FSRA argues that his past conduct raises reasonable grounds for concern regarding his ability to deal or trade in mortgages with integrity and honesty. As a result, the FSRA is proposing not to renew Attard's mortgage agent license and to impose administrative penalties totaling $25,000. In response to these allegations, Attard has requested a hearing before the Financial Services Tribunal. This step allows him to contest the FSRA's proposal and present his side of the story. It's important to note that these are allegations at this stage, and Attard has the right to defend himself in the tribunal process. For those interested in learning more about this case and FSRA's broader enforcement activities, you can access their enforcement database. This resource provides insights into how the FSRA is working to protect consumers through their ongoing monitoring and enforcement actions. Before we wrap up, it's crucial to understand that regulatory bodies like the FSRA play a vital role in maintaining trust and integrity within the financial services industry. By enforcing compliance with established laws and regulations, they help protect consumers and ensure that industry professionals adhere to high standards of conduct. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.